I should have bought Bitcoin.
The should have word is the most horrible word you have in investing because there's nothing you can do about it. Nothing you can do about it. Nothing you can do about it. Nothing you can do about it.
Strolling through the CBD, I can't help thinking just how much money flows to our economy every single day. And yet, none of it seems to be flowing into my wallet. And it's my own fault, I know. I'm turning 30 this year, and yet I never quite learned how to invest, especially in the stock market. The stock market today is so volatile, so intimidating, and I don't even know where to start. More informed people around me keep telling me that while savings are important, given the rising cost of living and global inflation, savings will not be enough to protect me in the future. I decided it was time to learn. I set a test for myself by picking a few stocks to invest in, just to find out if I can beat the market. These are the 3 hot global stocks that I've identified. Let's say I buy one of each stock. Let's check their performance and see how we do in a month. Whew, it's been 4 weeks and quite the emotional roller coaster. Here's how we've done. 2 up, 1 down. Overall, I'm up 4.5% versus the S&P 500. So that means I've beat the market, right? I'm here today with Daryl Ho, Senior Investment Strategist at DBS Bank. Thanks for joining us, Daryl. So
will I get cancelled by Gen Z for showing my ankles?
What do you think of the choices that I made?
Apple's up.
Yeah, quite a lot actually.
Quite a lot,
surprised.
yeah. So well done on that choice.
All luck.
And you also have a Tesla, kind of a flat to the market. Amazon didn't do so well, I think, if I looked at the numbers. So 1 up, 1 flat, 1 down. You're up 4.5%, but I think in the same time period, the S&P was up around 4%. Yes, it's a 0.5% difference, but what's invisible is perhaps the risk you took to get to that point, right? So if anything goes wrong with one company in the S&P 500, it's not big, whereas in a 3-stock portfolio, if anything goes wrong with one company, that's 1/3 of your portfolio at risk. The analogy would probably be like in basketball, if you did a Hail Mary from like the full court and then it goes in and you won the game, great, you won the game, but you took a big risk to get there. And I think that's kind of like what was happening with your portfolio.
You hear all these horror stories about how tech is like so volatile and the stock markets are so volatile. Maybe you could share a little bit about what are some areas that people can look into for safer investing, like just as you're starting out, whether in or out of tech.
The other analogy we like to paint for investors is to have a barbell strategy when you're investing. So that means in your portfolio, you have 2 outsized positions on 2 different types of asset classes. One end is what we call growth assets, which I think the tech trend fits very well in that growth trend. So you have that covered. But don't forget that the other end of the barbell is something that we call income generators. Your returns are gotten from dividend payments or interest payments, regular intervals of income streams. Right, and so it has a completely different return profile compared to growth companies like Apple's and your Teslas that can be very volatile but can give you very good gains. So what you've done with your portfolio is more like a kettlebell, right? It's just one lumpy weight, fully focused on tech, which if you work out with kettlebells in the gym, you do something wrong, you can throw out your back. So similarly, the risk can be very high as well if you're just focused on just one particular aspect and not thinking about other more refined parts of your portfolio that could balance it.
How do young people who are getting into it now and don't know anything, how do they protect themselves from just getting suckered into like whatever is the first and loudest thing that they see out there?
There's a great phrase we use in investing. How do you decipher the signal from the noise? When there's a lot of noise, what's the real signal that really affects your portfolio? And I think that's the biggest skill that you need to have in today's environment of investing, because there's really too much out there. And Warren Buffett always says, be greedy when others are fearful. But the truth is, when everyone else is fearful, you cannot help but feel part of that fear as well. So very frankly, we have to condition our responses in a way to be quite counter to what you're used to, right? So when you see everyone making a lot of money, and you are a little bit jealous, a little bit FOMO, like, I want to jump in that Bitcoin thing too, you have to step back and say, is there a legitimate reason for this? Should I be cautious right now when everyone else is so exuberant? You moderate your own and you regulate your own emotions to the noise around you, and you realize that when you are able to do that, you make better calculated decisions about managing your money.
So as an investment newbie, what do you think your top 3 tips would be?
My first tip would be to know yourself. Know what sort of risk tolerance you can have. Again, the first idea is that you're sweating buckets when you're looking at your portfolio. You're probably putting in too much, right? That's knowing your risk limits. The second is go for indices, right? If you want to expose yourself to the markets, having a diversified basket of stocks allows you to not be at risk with any one company at any time in a very meaningful way, right? And so you start yourself off with a very good grounding. Number 3 would be to dollar cost average, right? To have the discipline to put in a sum of money at regular intervals, regardless of the market condition, because you are investing for your future and not for the present. And I think with these 3 very basic principles, right? Principles that I default to even as a market practitioner, you can kind of tell that it's really important. So I think I would really encourage everyone else to kind of think through this seriously if you want to have longevity in your investing journey.
Okay, I know that 1 month is an extremely short amount of time to judge portfolio performance, but I'll say this experience has given me a snapshot into what getting into the world of investing would feel like. Investments can go up and down just like that, and beating the market is extremely difficult. I may have came out fairly unscathed from the past 4 weeks, but I'd say that's all down to sheer dumb luck. After chatting to professionals like Daryl, it's actually become quite clear to me that the best way to approach investing is to take a long-term, balanced approach. The journey to investing can be scary and really emotional, but tune out the noise and focus on your goals. Good luck! For more adulting tips, subscribe to the Head Start newsletter. Bye!